Cheers.
So welcome everyone to this seminar hosted by the Institute of Trading and Portfolio Management. We're lucky enough to have Anton Kreil with us here today, Managing Director of the company, who's flown in from Singapore especially to give this presentation. And it wasn't long ago that I was sitting there in your position listening to one of Anton's presentations back in 2012 with little or no trading knowledge myself and just looking for somewhere to learn. And Anton's certainly been a great mentor to me over the years, as I'm sure he will be with you guys going forward. So that being said, it's my pleasure to introduce our speaker for the evening, Mr. Anton Kreil.
Cheers. Hi guys, welcome. So we're short on time today. It's a huge presentation. We're not going to be able to take questions during the presentation, but we're going to be in the pub later. You can see some of the mentors here as well from the Institute, so you can ask a lot of questions there later. We're going to aim to get finished by around 9:15. So without further ado, let's get on with it. So here's the schedule for today. First thing we're going to look at, we've called it the other side of the fence, professional trading knowledge that professionals do not want retail traders to know. Some of the things you're going to see today are very harsh and aggressive home truths. And you might not like some of the things you see, but it's honest, it's truthful, and you've just got to deal with it. There's things that professional traders don't want you guys to know, so they are at an informational advantage in the financial markets versus you guys. We're going to look at some of the market participants, the broker, the educator, and the retail trader, how your side of the industry works. So basically not the professional side, and we're going to look at the differences. We're going to look at something called the inversion narrative, so why the vast majority of retail traders in the UK, Europe, and Asia lose money, and why the vast majority of retail traders in the US lose money. There's some subtle differences. And we're also going to look at charlatan educators, fake traders, how these guys create a story about themselves and suck naive retail traders into believing what they want you to believe. So I'm going to show you how to spot these guys. And then we're going to look at how you actually go about getting consistent profitability as a retail trader. So let's get started. First things first, why the hell do we care? How many people here have actually traded? Who's got a brokerage account? Okay, so that's quite a lot, 40% of the room. Who hasn't? Who's never ever tried it? Okay, so the minority of the room has never actually pushed the button. Okay, so that's quite interesting. So, why do we care? Well, people have tried, and the vast majority lose money. But if you haven't tried, if you haven't done anything in the retail trading world, whether you like it or not, you are in the finance industry. If you participate, if you've got a mortgage, you own a business, you own a home, you've got a bank account, a credit card, a debit card, whatever, you are in the finance industry whether you like it or not. You are a participant in the economy. But there's another reason as well. Pensions. The pensions infrastructure that was essentially set up in the 70s has failed the Western world. What's the pensions question? The pensions question is, can I get income in retirement? Can I live my life in retirement? And the pension solution is to provide that income, but no one can retire. What's the average pension number in the United Kingdom? Average pension balance. It's about £30,000. In the US, in dollar terms, it's about $60,000, $70,000. In Europe, it's about the equivalent of the UK, about £30,000. So about 40,000 euros. Asia, there's varying degrees. So for example, Singapore have the highest pension values in the world. The average pension value is $330,000. But there's reasons for that, which is another lecture. But essentially, in the Western world, pensions have failed. So what's happening? Boomers and Gen Xers are desperate. because they know they can't retire. So people are always looking for a solution. And this is why people come to seminars like this. But you've got to be warned. You're not the only people that have realized this. Everyone's realized it, and also an entire industry has been built around a narrative to provide you with solutions to this problem. Essentially catered to the desperate middle-class fool. Now, this idea of learning how to do everything yourself, it's a noble idea, but it's fraught with dangers. Because there's a lot of bad people in the world who want to cater to the middle-class fool, and those bad people do things that are not good for you. They're only good for them. And our continuous campaign at the Institute is to basically first show you guys how it actually works. Show you basically how the landscape, how the industry works, so you can figure out how not to lose money, how not to fall into all the traps, how to make all the classic errors as a trader or an investor. And then the second thing we do is actually teach you how to then go and make money. So the first thing you have to do as a retail person in this industry is to essentially make sure you have no downside. Don't do all the stupid things. Learn how basically to avoid all the mistakes. Then it's about learning how to make money over time. And we've been providing the information in this seminar, for example, for close to 5 years in closed seminars. So it's never been publicly available. And this is why we're filming today, because we're now going to stick this on YouTube. And the whole world's going to see it. And this is why you have to, if you've heard of this phrase, be woke. Okay? What you're going to get taught today, pretty much every retail trader will never, ever figure it out. And it's pretty simple, straightforward stuff. But most retail traders, the vast majority, will never figure it out. And even if they do, they've been on a journey where they've lost so much money to figure it out, it's now pointless. So here, we're literally saving you a lifetime of losses. Or if you figure it out after 10 years, a decade of losses. So this is really useful information. First thing you have to do when entering any industry whatsoever, if you were going to set up a new business, the first thing you would do is do an industry appraisal. Who are the winners? Who are the losers? How's the industry set up? What parameters can I operate in? How do I be successful? What mistakes do I need to avoid? If you were going into any industry, you would do that as a smart business person. Why would you not do it in trading? It's the first thing you have to do. And there's been some major trends in the last 30 years that really affect retail. And they're very important. They have significant consequences. The first one is how the market's set up. Who owns the exchanges? The exchanges is where all the business is cleared. Every time you press the button, the order goes down a pipe, through a broker, through an investment bank, to the exchange. Who owns all the exchanges? Well, there we have it. Intercontinental Exchange, ICE, own NYSE and Euronext. That's the majority of business in the market. The Chicago Mercantile Exchange owns the Chicago Board of Trade, NYMEX, and COMEX. So basically we have a monopoly / duopoly. What does that mean? What do we think it means? Who does economics here? Monopolies, do we like them?
No.
What's the negative of monopolies? Potentially. Pricing power, and control. So we'll come back to that later, but the exchanges are now basically owned by a couple of companies. And by having a monopoly, they can control the market if they want to. How the market is set up, how the players must operate, who they incentivize. Parameters like this. We'll come on to it later again. Second, technology. Obviously, technology's played a major role in the last 30 years. First things first, infrastructure. Massively increased retail trader participation 30 years ago, you'd be on the telephone, calling a broker and just accepting the price on the phone, whatever you got. What have you got now? Well, internet penetration, internet capability, speeds, very low barriers to entry. Everyone can trade from their bedroom or their phone. Very easy access. Is that necessarily a good thing? If you have access, does it mean you're good? Of course not. Hardware, microchips, processing speeds, massively increased. And then that's affected the penetration of retail traders, much lower cost of production. Again, lower barriers to entry. Software, connectivity to financial markets, and everything being organized for you. So making life easier. None of it actually means that the trader's going to be profitable. It just means you're supposed to have better access and better capability. It's supposed to help you more, but it doesn't necessarily mean you can make money. Regulators. Every problem we've had in the financial markets in the last 30 years, the regulator's done nothing to stop it before it's happened. It's always happened afterwards. The regulator is always passive and reactionary in pretty much every geography in the world. So in 2010, one of the main instruments that retail traders use are contracts for difference. They were banned in the United States. Why? Because too many people lost too much money too quickly. Also in 2010, IB contracts, which we'll come to later. Does anybody know what IB stands for? If you do, it means you're in the industry and you're on the brokerage side.
Introducing broker contract.
Introducing broker contract. Are you a broker? Yeah. Congratulations. You're not going to like this seminar. Okay. So IB stands for Introducing Broker. We'll go into the details on those later. But essentially it means that people introduce retail traders onto the broker's platform and get a kickback for doing so. They were banned in Singapore in 2010. Why do you think they were banned? Why do we think they were banned in Singapore? Because they're great?
Conflict of interest.
Conflict of interest. Hit the nail on the head. Loads of bad people were turning up into Singapore, like they do all over the world, and teaching people absolute nonsense, putting them on trading platforms, and everyone was blowing up and losing their money. So the regulator, government, stepped in and banned them. And this is very typical of regulators. They do it after the event. So what does that mean if you're a retail trader? Well, history tells us, as a retail trader, you have to regulate yourself, because the regulator's not going to save you. They're passive, reactionary. You'll lose all your money. Then they might change a law afterwards. Doesn't matter. You're done. You're out the game. Financial markets volatility. Volatility in all the major asset classes since the financial crisis, so 08, 09, so from 09 onwards, has been crushed. What does that mean for traders? Sure. So volatility for traders is the lifeblood of a trader. A trader is a slave to volatility. Because without volatility, you don't have any risk and you don't have opportunity. And risk and opportunity are two sides of the same coin. It's called volatility. And if volatility gets crushed, risk and opportunities get crushed, which means returns over certain periods of time, over certain time horizons, peter to zero. So why is financial market volatility being crushed in all the asset classes? Well, the first main reason was the monetary policy after the financial crisis. So if you remember, the Fed was implementing QE, quantitative easing. What does that do? Guaranteed buyer of bonds, suppresses yields permanently. That feeds over into other asset classes because money keeps buying other asset classes to chase yield, which suppresses yield. So it goes all the way through the asset classes. Obviously, they stopped a few years ago, but there's other reasons as well. Technology. Why does technology and access for retail traders suppress volatility? Because there's more market participants. Why does more market participants suppress volatility? Because it increases liquidity. Why does more liquidity equal less volatility? In most cases. It means there's more willing buyers and more willing sellers at every price for an asset. Which means if you have an infinite amount of willing buyers and willing sellers, assets don't move. Create zero volatility. So this idea of trading now being like it used to be 15, 25, 35 years ago, where you can just turn up, day trade, and we used to call it scalping, is not existent anymore. It hasn't existed for a good 6-7 years. And this is why day traders have basically not made any money or lost money over the last 6 years. So this has had a huge impact on retail traders because there's less opportunities over shorter time horizons. So the professionals have totally changed their approach in the last 7 years. Why? Because professionals do what the market tells them to do, not the other way around. And we get this message through the Institute probably 10 times a week, exactly the same question through the website. And it's literally worded the same all the time. I am a Forex day trader. Can the Institute's education help me? What's wrong with that statement? Why is that? We think it's the most stupid statement or question anyone can ask as a trader. Why do you think that is?
The person is trying to dictate to the market how he's going to trade.
Exactly. So the person is literally saying, I only trade one asset class and I only trade over one time frame. That's all I do. Now think about it like this. Euro dollar, most liquid Forex pair in the market. What's euro dollar done in the last 18 months? 104 to 113. That's been the range. What happens if euro dollar is 106 from now to over the next 250 trading days? And every day you buy it at 106 and sell it at 106. What happens? Can you make money? Well, of course not. So this idiot is going to be sitting at his desk for the next 250 days saying, I am a Forex day trader, can the Institute help me? What mistake has that person made? They've limited their opportunities because they're only trading one asset class, one time horizon, and they don't have any ability to trade anything else over any time horizon. That's the first error everyone makes in retail trading. What you have to do in your first 1 to 2 years as a retail trader is to learn how to trade everything and get yourself a proper educational foundation so you can follow the volatility or predict where it is and go where the money is. So if you're over one time horizon in one asset class and it stops working, you can shift and move. You don't define yourself by one asset class over one time horizon. And the only way to do it is to emulate what professional traders do, and that's what they've done. So on the left-hand side, we've got pretty much all the behaviors of a professional trader, and on the right-hand side, all the behaviors of a retail trader. What's the approach of a professional trader? Systematic, mostly long-short portfolio management across multiple asset classes. No narrow definition. Every trader wishes they could have an infinite discretionary mandate to be able to trade anything at any time in any way they wanted, so they can just follow where the money is. So this idea, the popularized perception of a trader, as in you see lots of guys screaming on a floor like in the movies, it doesn't exist anymore. It's complete nonsense. But there are people in the world that wish it was the case, but it's all pretend. It's a narrative that people use to get you to do things that you don't want to do. The pro-trader approach is 80% fundamental, 20% technical. In the vast majority of cases, investment banks, at prop desks, and hedge funds. Retail traders, what's the approach? What do retail traders tend to do when they approach the market? Short time frames. Everything's over 1 day, 4 hours, 2 hours, 5-minute candles, 1-minute candles. Always looking for quick returns that potentially don't exist because they're not actually monitoring volatility correctly. What's the outlook of risk for a professional trader? This is where they differ as well. Investment bank prop desks and hedge funds will have multiple positions, long and short, and they will build portfolios. Usually position sizes are 5 to 10% of portfolios. So you're looking at 10 to 20 positions in a portfolio. And they'll trade correlation within the portfolio, and not one position will be allowed to blow them up. That's why they have position limits like this. What's the retail trader approach? What happens when you open a typical retail trader account? Well, actually, a very, very high percentage of retail traders don't have any positions. There's a massive problem in the brokerage industry, and we get asked to try and solve it all the time, which is dormant accounts. Guys who go to seminars with brokers and educators, they get convinced to open a trading account. They deposit a couple of $1,000 or $10,000 or 25 grand. They go home and they realize they don't have the confidence to pull the trigger. Why? Because they realize that what they've just learned is a load of nonsense. And then they leave their money there. It earns no interest, and every month they pay inactivity fees to the broker. What does the broker want them to do? The broker wants them to trade, of course. What about the rest of the guys? If you open up their account, typically 2 or 3 positions. Their favorite Forex pair, long or short, because it's in the news every minute of every day. Short the S&P 500, because they're reading doomsday research online and watching too many YouTube videos. And usually their favorite cheap stock, which they bought 2 years ago, it's now down 50%, and they're moving it over to their pension because they can't bring themselves to sell it. That's a typical retail trader account. Think of all those mistakes. They're really, really common. Professional traders don't do that. It's all about portfolio management and getting consistency in return, which is the next point. With pro traders, consistency means risk-adjusted returns. Risk-adjusted returns. What does that mean? Let's think about this with 2 traders as an example. Trader 1, and let's say you're pitched to invest money in either of these traders. Trader 1 takes 50% risk per annum, annualized volatility in their portfolio. You can measure the volatility of a portfolio, very easy. 50% risk a year and gets 25% return. And trader 2 takes 10% risk per year and makes 16% return. Who's the better trader? Of course. Trader 1, you can't invest in. So whatever you put with trader 1, he could blow up literally in 6 months. And your investment is 0. With the other guy, he could lose 10% in a year. But he's knocking in 16%. His return is higher than the volatility of his portfolio. He's an efficient, optimized trader. And a lot of these hedge funds are literally employed to do that. So they will have a volatility cap on their portfolio that they can't go over. They're not mandated to take the market risk. They're mandated, for example, to take 10% risk. That's why their investors are investing. So if they don't beat the S&P, they don't care. Because they're signing up to take 10% risk, no more. What do retail traders do? Everything short-term binary. So they'll have no positions or 1 or 2 positions. They'll sit around for 3 weeks waiting for the non-farm payroll number. And then they'll take a bet 3 minutes into it or 2 seconds after it. And the vast majority of time, they're cutting afterwards. And that's probably one of the stupidest trades you'll ever do, because all the professional traders have got a very, very good idea what the number's going to be. And when a retail trader reacts to it, the professional traders have already predicted it, and retail traders are providing the liquidity to the professional side to get out of the trade. So professional traders have predicted that number for a month before. And even if it's higher or lower than consensus, which is economists, the professional traders have predicted that it's going to be higher or lower than consensus. It's called the whisper number. And the market moves on it only because of retail traders. Professional traders don't trade on it and initiate positions. They use the liquidity to get out. So it's all short-term binary for retail traders. And the short-term binary approach provides liquidity for the smart guys who are predicting the future. It's providing liquidity for them to get out. What's the outcome of a professional trader? What do they want to achieve? Well, the first thing is capital preservation and then growth. The retail trader wants to achieve big money very quickly and not necessarily consistency, and the outcome is they just blow up. Capital destruction. So the key differences here, the professional traders have realistic expectations and targets, and their target is to get rich slowly. And they want to trade forever, or at least until retirement, or until they die. Retail traders, very unrealistically high targets, and they never meet their targets. So they stay poor or get poor quicker. Expectations are never ever met. Targets are never met, and they just blow up. That's the typical scenario. Now I want you to think about this in terms of a retail broker. A professional trader's broker is the investment bank. That's an institutional broker. Let's think about a retail broker who's got 10,000 retail clients and 90% of them lose money. How does the business grow? Let's think about the reality of this business. If you own the brokerage company, how do you grow it if 90% of your clients lose money? You have to spend a significant amount of the money that you make from the guys blowing up, and it's usually between 30 and 50%, on marketing to get new guys to open accounts to replace the accounts that are blowing up and closing down. That's the only way you can actually stay at the same level. If you want to grow, you need to open more accounts than the ones that are being closed down. So imagine you have 9,000 out of 10,000 clients down at any one time. What would you do if you had access to 9,000 traders who always lose money? Come on, someone think outside the box here. There we go. You take the other side of their trades, wouldn't you? Why? Because then you'd have a 90% win ratio. You'd be the best trader in the world. So what we're going to show you here applies mostly to international markets outside the US. As we mentioned earlier, US CFDs were banned. So we're going to look at CFDs mostly, how these contracts operate, how the brokers operate within that industry. We'll have a look at US brokerage companies later. US guys mostly trade options. So we'll concentrate on outside the US, as in the rest of the world. So we're going to be looking at UK, Europe, Hong Kong, Singapore, Middle East, Australia, New Zealand, South Africa. What we'll show you here initially is what happens in all of these territories. All the same brokers are in all the same places. So I've mentioned this briefly again, the 90-90-90 phenomenon. Who knows what that stands for?
90% of traders lose 90% of their money 90 days.
Yeah, 90%. Let's be specific of how it works. 90% of retail traders, so the retail brokers' clients, lose 90% of their deposited margin within 90 days. So what is margin? It's the money you put in your account, and you get leverage when trading CFDs. But what is a CFD? Well, you don't actually own the asset. CFD is contract for difference. So if you were to buy a CFD on a stock, it's a contract that is supposed to mirror the price of the underlying asset, as in the real stock. So when the real stock goes up a point, the contract is supposed to go up a point at exactly the same time. That's what it's supposed to do. So when you're on the platform and you press the button to buy on a CFD platform, you don't own the stock. You own a contract that mirrors the price. And that's why it's called a derivative, because the price of the contract is derived from the underlying asset. And there's two types of margin. There's the initial margin that you put in your account, and then once you have a position, what we call variable margin. How much your margin is going up and down, how much you're making or losing. Because what happens at the end of the day, if you buy the contract and the stock goes in your favor, the broker pays the difference into your account. Contract for difference. If you have the reverse situation, the broker takes money out of your account if you're losing money. And what happens when your margin goes to zero? You get a margin call. You have to deposit more money in your account, and if you can't, the broker will stop you out of the position and you're done. Your account's blown up. So that's why we call them contract for difference, because the difference is taken out or put in. Typically in Forex, obviously Forex is a very popular instrument for a popular asset class for retail traders. Typically in Forex, whatever you deposit in your account, you are allowed to borrow up to 100 times what you put in your account. So what does that mean? Well, it's 1% variable margin, which means if you lose 1%, it goes to zero. So let's say you put $1,000 in your account, you'd be allowed to take up to $100,000 of risk, equivalent in the currency pair that you're buying or shorting. And if you lose 1%, you're gone. But what if you put 10 grand in your account? So in that scenario, you lose 100% of your margin. What if you put 10 grand in your account and had 100 grand risk? Well, if you lost 1%, you'd lose 10% of your margin. That's how it works. So what do most retail traders do? What do you think the average balance of a retail trader's trading account is in the UK, Europe? So this is in rest of world, outside the US. It's a couple of $1,000s. And what are they doing? Taking $200,000 positions in Forex and blowing up in days. 100 times leverage, we call it. With stocks, commodities, ETFs, you're looking at 10 times leverage. So the numbers work exactly the same. If you lose 10%, you're out. But think of all these guys on the platform trading in the way that we've discussed, in the opposite way, to the way retail professional traders do it. Wouldn't it be amazing if we ran a company where we could just take the other side automatically every time they traded? We'd win 90% of the time. And this is the big problem. The way the brokerage industry works is that there's major conflicts of interest with retail traders. So major conflicts of interest between the broker and their clients, the retail trader. That creates a scenario where that literally happens because those guys want it to happen. The infrastructure has been built not for your benefit. Your objective is to turn up and make money. That's not their objective. Their objective is the opposite to yours, which is to take your money. So the first two conflicts of interest are really obvious. There's four main conflicts of interest. Spread and commission. So spread. What's spread? Well, if you buy something, you're buying it in the market, for example, at 6, and if you sell it, you're selling it at 5. So the broker makes 1. You pay the spread. So if the broker has 2 clients, the broker can buy it at 5 and sell it to you at 6. So 1 seller, 1 buyer. They make a spread. So they make a spread on every trade and take turns. We'll use this phrase again in a second. The word turn. Taking a turn is buying something at 5 and selling it at 6. So the spread and commission. So spread happens in Forex. There's no commission in Forex. You pay the spread in Forex. You pay the spread in stocks. But in stocks, you also pay commission. So you'll pay a percentage commission to trade in and trade out. So those two are really obvious conflicts of interest, but everyone tries to ignore them for some reason. So what does that mean? those two things mean that the broker, by default, is absolutely 100% incentivized by volume and frequency. So they want you to trade in the biggest size possible as frequently as possible. So put 2 and 2 together. Why do they lend you 100 times what you put in your account? Because they get paid. The next two are not so obvious. The financing turn and the OTC gain. Does anybody know what OTC means? Over the counter. Right, so CFD contracts are over the counter contracts. Okay? And when they take the other side and make money, it's called an OTC gain. First incentive, we'll just get it down now. First retail broker incentive, volume and size. Trading as frequently as possible in the biggest size possible. That's how they get paid. The other two, not so obvious, this is how it works. So the first one, financing turn. Who finances the leverage with brokers? Does the magic money fairy from the sky come down and give brokers money to lend to you? Where does it come from? Comes from investment banks. So if you want to set up a retail brokerage company, get yourself $30, $50 million, go to an investment bank, use that money to collateralize some debt, and ask them to borrow $250 million. Ask them if you can borrow $250. You get yourself a revolving credit facility, build a trading platform, and then farm out the credit on the platform to retail traders. So you borrow at, pretty much now, this will be the case, you borrow at 2 3/4, farm it back out for a point higher. So you take a financing turn on the debt. But what else gets collateralized? How do you get away with turning up to the investment bank with only $30 to $50 million regulatory capital and then borrowing $250? How do you get away with that? Because retail traders are going to open trading accounts. And when they put their money in the accounts, that money is collateralized as part of the revolving credit facility. And then you're basically putting the money in your account and sponsoring the broker to lend you money at a point higher. So essentially, you're financing your own rape. That's how it works. Now, of course, if 90% of clients lose money and you want to take the other side, you want to borrow as much as possible so you can take that other side. So, of course, you're going to lend out as much as possible, teach people how to trade as frequently as possible in the biggest size possible, so they pay you. You take a point on the financing, and then you get the gain on the other side when they lose. So retail broker incentive 2. Provide third-party financing with no risk or very little risk. Take a turn out the financing and use the credit facility to encourage retail traders to trade as frequently as possible in the biggest size possible and take the other side of all the trades. Not a bad business. And again, why are we looking at this? You need to understand the realities of the industry. Step 1. This is how it works. Step back for a second and think how long it takes you to open a trading account. Quite a few of you have opened trading accounts before. How long did it take you? Someone shout out. 10 minutes? What did you provide to open the account? Passport? Utility bill? So identify yourself. Utility bill? Confirm address. You are who you say you are. What else did you have to do? You'll sign some terms and conditions because they'll qualify you as someone who's got money. Did you read the small print? Sure. And we're assuming everyone's non-professional. So in the terms and conditions, what are you actually doing when you sign them off? The only line that matters is one line, and it'll be in there somewhere. I'm happy to lose all my money. And the broker is not, it's not his fault. Broker's got nothing to do with it. It's a risk disclaimer. I'm happy to lose all my money. So that's all you do. Passport, utility bill, fill out the terms and conditions, sign it off. I'm happy to lose all my money. Then what happens? You've got a trading account. You've got access. A total stranger who's never met you is willing to lend you 100 times what you put in your trading account because you provided them a passport, a utility bill, and said, I'm happy to lose everything. Welcome to the world of retail trading. But why are they doing that? Why is it so simple and straightforward? Well, think about the regulators. Passive, don't care. They react. Retail brokers, clearly with these conflicts of interest, are absolutely incentivized to create a narrative around the infrastructure that increases your chances of losing money. In fact, the infrastructure itself is self-perpetuating. Think about it like this. If you own that company where you've got 10,000 clients and 9,000 always lose money, and you're spending 30 to 50% of your money to replace them every month, the ones that are closing down, what happens when a new guy opens their account? Well, you know you've only got 90 days to rape him. So what do? Do you wait 90 days? No, you get on with it. You do it as quickly as possible before he disappears. You've only got 90 days to take the money and take the ownership of that money from his account to your account. So it becomes self-perpetuating. It's a very negative feedback loop. So they're very, very heavily incentivized to make you believe in short-term trading and to trade in the biggest size possible. So they can make the 4 revenue streams: spread, commission, financing turn, OTC gain. So write them down. Make sure you don't forget them. This is how the industry works. Volume and size incentives, spread and com. Third-party financing with a turn, and OTC gain. And this is what the industry looks like. This is what the trading industry looks like, the infrastructure. On the left-hand side, we've got exchanges and investment banks. And everything to the right of that is retail brokers, trading educators, retail traders. We've put a few labels under each. So the investment bank, what are they doing? They're providing the credit facility and clearing to the brokers. And that order flow goes through them electronically down to the exchanges and trades. It all happens within less than seconds. What's the retail broker doing? Well, the retail broker, if we skip the educator for a second, the retail broker is providing the access, so platform and software, financing, leverage, and liquidity. Now that's important because without the brokers, you wouldn't have liquidity. So that's the positive that retail brokers provide to retail traders. You can access liquidity that you wouldn't get anywhere else as a retail trader. So what does that tell you? It's a necessary evil to use retail brokerage platforms as a retail trader. You have to use them. We'll come back to that later. But what type of education do you get from brokers? Well, there's an incentive. There's a conflict of interest. You're not going to get education that helps you make money. You're going to get education that makes you behave like a monkey. Press the button as many times as possible per day until you blow up. And it'll be wrapped up in some sort of strategy. Usually a technical analysis strategy, very short term, less than a day, in hours, in minutes. Follow this line on a chart. Every time this line crosses this line from below, buy. Every time this line crosses this line from above, sell. Signals, very typical. You're not going to get education that works. So they're providing this to the retail trader. What have we called the retail trader? Dumb money. Why? Because they believe everything that the broker tells them. And on the left-hand side, we've got the smart money, investment bank traders on prop desks. Why do we call them smart money? Because they believe nothing that anybody tells them in the market who has conflict of interest. We'll go into more detail on that later. They do the opposite of the dumb money. What's the retail trader paying? Spread and commission. What are they providing? They're providing the demand for the financing, the demand for the false narrative, and the demand for losing trades. So they're providing the liquidity, for all of those conflicts of interest. And we have the acronym there, COI. So if you see that in the presentation later, the acronym COI, conflict of interest. And the education is a false narrative. We're going to go into a little bit more detail on how this works in terms of the OTC gain and how all of the conflicts of interest work, how the drivers of conflict. So spread, commission, financing turn, and OTC. Believe it or not, it actually happens automatically. It's now all been set up to be automated. It's been going on for 7-8 years already. So if you're only learning this now, you're well behind, well behind. Think of the 10,000 client broker example. What happens when a losing client comes onto the platform and presses the button? Well, at 7 a.m., all the losing clients whose accounts are down go into one liquidity bucket, and all the guys who make money go into another liquidity bucket. The guy who loses money comes on, presses the button. They provide the liquidity automatically, instant. Take the other side. They could, if they want, hedge it. They could go into the market, the real physical market, and purchase the physical underlying asset. So then the brokers short the contract and they buy the underlying asset. But they don't. They stay short the contract. Retail trader loses, comes back, sells the contract back to the broker. Broker buys, closes out the position. Retail traders closed out, brokers closed out. Broker makes money, takes the difference out the account. What have they made on that trade? They've made every revenue stream: spread, com, financing, and OTC gain. And literally, it's all automatic. It's automated software. It happens in a second. So the hedge, if they choose to put it on, will happen automatically down the pipe through the investment bank. It's just a two-way pipe. Now, what happens if it's a guy who makes money? Well, the guy trades, buys the contract on the platform, broker shorts, automatically hedges by buying the underlying asset. The guy makes money, comes back, sells the contract, broker pays the difference into the account after unwinding the hedge. Has the broker lost money? No. So what's the broker made? They've made spread, commission, and financing turn. So they haven't made the OTC gain. What else has happened though? What else has happened in that trade? Look at the green bar. They've hedged. They need money to hedge. Winning clients are annoying for two reasons to the broker. One, because the OTC gain is eliminated, so they only make money on 3 revenue streams. But 2, they have to commit twice as much capital relative to a losing trader because they have to hedge. So winning guys cannibalize the broker's capital. So they're annoying. Losing traders are fantastic because they get the 4 revenue streams and they use X capital to trade with that client. Winning traders are annoying because they make less money and commit twice as much capital, 2X. So remember this trend over the last 30 years, the monopoly duopoly situation? Where's the credit coming from? It's coming from the investment banks. This is the value chain or supply chain of liquidity in the trading and portfolio management industry. Who owns the narrative? What's the perfect retail broker to lend money to? One that peddles the narrative. Why? Because the investment bank can lend them money and make money out of it forever. So it's starting to add up. There's a monopoly duopoly situation with exchanges and investment banks. Who are the biggest clients of exchanges? Investment banks. More on this later. But smart money and dumb money. This is why we labeled smart money on the professional side, investment banks, prop desks, dumb money on the right-hand side as the retail traders. Smart money understand how the financial markets work. They understand conflict of interest. It's professional trading 101. It's the stuff you get taught in your first couple of months at Goldman Sachs or any firm that's good. They avoid trading in the way that other participants in the market who have conflict of interest want them to. They avoid it. And they do everything in the opposite way to the way retail traders do it. What do dumb money do? Believe everything they're told and rely on the infrastructure provided to them by financial market participants with conflict of interest. Believe that the infrastructure has been built for their benefit when it's actually been built for the opposite purpose. They trade in the way that they're told to trade, and they do everything in the opposite way to the way professional traders do it. But there's a catch. We talked about it earlier with the non-farm payrolls example. That's very typical. Smart money requires dumb money to exist. Who's supplying the credit facility? The investment banks. Who's the perfect broker? The one that peddles the narrative. Who's the perfect client? The client that believes the narrative. And it creates the negative feedback loop, and the professional traders win. We can also add hedge funds and pension funds into here. So in the grey box on the left, hedge funds are smart money. They're basically exactly the same as investment bank prop traders. Pension funds are slow money. They're investing over a long time. But the key here is they are the market participants that are on the professional side, and they are the biggest clients of investment banks. And combined, investment banks, hedge funds, and pension funds are the biggest payers of exchange fees on the planet, and two companies own 90% of the order flow on all exchanges in the world. It's a monopoly. So what you're looking at, ladies and gentlemen, on the left-hand side is Wall Street. And if you don't think they all work together, you've got your head up your ass. There's not many of them. 6 or 8 investment banks control 90% of the volume. And everything on the right is dumb money and the inversion narrative. So everything we've discussed regarding the structure of the industry outside the US actually applies in the US too, but the CFDs were banned in the US in 2010. So what's happened since? Retail traders have been moving more towards trading options in the US. So they obtain their leverage through essentially implied leverage or implied volatility through trading options. If you wanted to actually trade normal physical assets in the US, the margin requirement is pretty high. So you don't get much leverage. It would be 33 to 50% margin requirement overnight. So 2 to 3 times leverage. And why do you think it's restricted in that way? They banned CFDs and that replaced it. And then everyone's going for options to get leverage. Index, Forex, and commodity futures, there's lower margin requirements, but the tradable set is pretty small, as in your amount of opportunities to make money because of the amount of contracts or assets you can trade is very low. So it's about 60 contracts, typically on a retail brokerage platform. And that compares to potentially 42,000 stocks. So your tradable universe is really small. And this is why options contracts have become very popular in the US, because retail traders can deposit less margin and get potentially much higher return if they make money through trading the option of an asset. And this is obviously a totally separate class in terms of options, but the two most important variables to consider with an option are theta, so time decay, and volatility. Theta, you have to be right by a certain date. Options adds this other element to a trade whereby you're not just long something and you can be long forever. You have to be right by a certain date. Otherwise, your option expires worthless. Volatility. Why is volatility important? Well, the more volatile something is, if volatility goes up, there's more opportunity to lose or make money. Well, risk and opportunity in the asset. So what happens when volatility gets bid up? When volatility goes up, options become more expensive. And retail traders don't understand how to calculate volatility and opportunity properly. So they always, for example, go long something and buy the asset at a level of volatility that doesn't even exist in the real market. So the odds are always massively against them. So what happens in the US is the vast majority of options expire worthless. Retail traders in the US use options as a proxy for simply going long or short the underlying asset without realizing that they have to be right by a certain amount of time, or the volatility that they're either going long or short can't be bared by the underlying asset's real volatility. But there's a very obvious question here. If 70% of options contracts in the US expire worthless, why don't you just sell options all day long? Easy money, right? Wrong. Selling naked options as a strategy constantly just to take money in, as in to get an income, is super dangerous. Why?
Unlimited losses.
Unlimited losses on many of the trades, yes. So if you do that, it's basically like picking pennies up off the railway track. You're playing a very dangerous game. If you don't have significant amounts of money to bail yourself out when you get 1 in 10 wrong, you're going to blow up very, very quickly. Now, do the brokers know this or not? Of course. So if you go on the platform and start naked selling options a lot, the broker's going to just stop you in your account from doing it and ask you to put up significantly more amounts of margin to cover the potential for any crazy losses. You essentially have gap risk in your trades. So you sell a call option, hence giving the buyer the right to buy the underlying asset at a certain price before a certain date. You take in a few $100, congratulations. Go to bed, wake up the next day, the company's been taken over for a 100% premium by one of their competitors, and you're bankrupt. Happens all the time. So that's why it's not that straightforward. Just because 70% of options in the United States expire worthless doesn't mean just go into the market and start selling options every day to make an income. What people don't understand in the US is that buying an option relative to buying a stock or a commodity or an index, buying an option on those products, there needs to be a marginal benefit in addition to owning the option than to just owning it outright. And if there's no marginal benefit, there's no point, because you have to be right by a certain amount of time. So the risk reward has to be much more favorable over the amount of time, and you have to see catalysts that the market doesn't see. And you have to trade at the right price. If you're not trading at the right price, the risk reward will never be in your favor. So again, this massive gap in education and understanding of how these things work exists in the United States. So the options class is a whole different class. But let's have a look at the inversion narrative. We already know what the incentives are, the conflicts of interest. These conflicts of interest lead to what we call essentially a front door to the industry of lies and bullshit. That's what the inversion narrative is. You're being told the opposite of reality and the opposite of truth. So you fall for the narrative and do everything that they want you to do. And these lies and the bullshit is extremely intricate in detail. You've got to have a very, very well-trained eye and understanding in the industry to recognize some of the things that are going on. What does the inversion narrative exist for? It exists so they get paid. And wealth is transferred from your pocket to theirs. It's that simple. First thing we'll look at, introducing broker agreements. This is infrastructure that was inside that chart that we saw of the industry, and we briefly mentioned it. The retail broker provides contracts to people called educators. And these contracts are called introducing broker agreements. Now, the broker has to do this. In every country where there's regulation, the broker has to provide a contract to somebody who is introducing people onto their platform. What do those contracts typically state? Whoever you put on the platform, whatever they pay us, every month we'll rebate you 25 to 50% of the money they pay us. So what does that mean? Conflict of interest. It means that the trading educator is incentivized by exactly the same formulaic process as the broker. So what do they want you to do? They want you to trade in the biggest size possible, as frequently as possible, and believe the inversion narrative, and lose. Now in the US, this happens all over the rest of the world, outside the US. In Singapore, they're banned. In the US, a trading educator can't get a percentage rebate. They'll get a flat rate. But the inversion narrative still exists. Why? If you get paid by the broker as an educator, whether it's a percentage or a flat rate, it doesn't really matter. The outcome is the same. What's the outcome?
You still have the volume incentive, just not the price one.
No, so let's say, for example, you got introduced onto a platform and the trading educator got paid $500 flat rate. Why does the trading educator care how much you trade?
He doesn't.
Well, he does. Because the broker is paying him and he's the broker's bitch. He works for the broker. And the broker will not work with an educator who doesn't push the inversion narrative. They won't even get a contract. They'll have their contract cancelled. So this is why when we look from the left-hand side to the right-hand side of the industry, those red arrows you see are essentially arrows of where the narrative is coming from and the power is coming from. Because all the way from the left to the right, every participant individually, as you continue across, is the bitch of the one next to them. Does that make sense? They won't even get the contract. The contract will get cancelled. And then the trading educator doesn't have a platform that they can introduce their students onto or their clients onto. So then they're lost. They don't have a business. Make sense? They're the bitch. So how does the Institute get around this? We spent 4 years doing this, convincing brokers, because they have to have the contracts in place by law, by regulation. We forced the brokers to write 0 on the contract. So it says on all our contracts, the Institute will receive 0% rebate and commission and flat rate. 0. Why do you think we do that? To eliminate the conflict of interest. Because we know if it's there, only bad things can happen. Why would the brokers do that? Do you think the brokers like that?
Trading volumes.
Why would they not like it?
They lose the source of revenue. Inversion narrative doesn't exist.
Yes, potentially.
They can't get the bitch.
Less bitches. Less bitches, more winners. So think about it like this, right? If you're the brokerage company with 10,000 clients, okay? What did we look at before with marketing? 30 to 50% is spent to get more accounts in, to open more accounts than accounts are closing down, okay? What do IB agreements provide brokers? They provide them with distribution and marketing where they don't have to pay marketing dollars up front. So a trading educator is going out on their own dime, setting up events like seminars, webinars, stuff like this, teaching nonsense, introducing guys onto the platform. They pay commission. They trade as frequently as possible in the biggest size possible. Broker takes the money in. Hasn't cost the broker anything. And then a check goes back out every month, 25, 50%, or a flat rate to begin with in the US, but they won't work with anybody who doesn't push the inversion narrative. So what is it doing? It creates infrastructure that lowers their marketing cost. So if you write 0 on a contract, why would you not want to do that? Because you want the traders to be, the trading educators to be incentivized to get people onto the platform because it's lowering your marketing cost. It provides distribution. Does that make sense? So the status quo must be maintained. So they don't like it. But there is a discussion to be had with brokers as to why there's a big positive for it. Why? Why is there a big positive? Sorry?
Still three income streams, commissions, but
No, it's not the revenue streams.
retention?
Retention is a very, very big positive. So if you introduce guys who only make money, they're never going to close their accounts. Of course.
It's cheap marketing.
Cheaper marketing. What else? What do you think is going to happen in the future with IB contracts? Who banned them in 2010? Singapore. Who recently banned them? And who recently banned CFDs? Belgium. US bans CFDs. It's our strong belief that IB contracts at some point will be banned everywhere. So here's your first trade idea. First trade idea from the Institute. The morning you wake up and you see the headline, IB agreements banned in UK, Europe, US, everywhere. What happens to the publicly listed brokerage stocks? They're down 80%. Forty, 50% of their clients come from the distribution of individuals introducing people onto platforms. So that's gone. Distribution and marketing is gone. But if you sit there and tell them that, maybe the trade doesn't exist because they can save themselves before it happens. So the conversations we've always had is, this is going to happen, and you know it's going to happen. So you need to set up infrastructure internally that hedges your business against that happening. And the day it happens, all you have to do is send out an email to all of your educators and tell them, here's the new contract, sign it or go away. It says 0. And it can all be sorted out in a day, and you can make a public announcement and say, our distribution stays the same. And where else are they going to go? Because if they've been banned everywhere in the country that they're in, they can't say to the brokers, oh, I don't like that, I'm going to one of your competitors, because they've been banned everywhere. So the infrastructure can be set up very quickly, very efficiently for the brokers to respond to that in the future. Retention is a big one. Instead of having to spend marketing dollars all the time to open trading accounts that are opening more trading accounts than are closing down, it lowers marketing dollars because you give them a coupon business. It's like a bond. So if you put 100 traders, like institute traders, onto a brokerage platform, and they're trading 2 or 3 times a week, and they never blow up, it's like the broker owning a bond. They're getting paid a coupon constantly. What if a high percentage of your guys make money? Well, they don't like that either. That's annoying. So they're told to hedge, and if they don't, they've only got themselves to blame. And we don't want to hear them complaining and crying like bitches on the phone. So we're very straight up with them. We will give you a coupon business and a business hedge, but we want 0 on that contract. You should hedge everything we do because a very high percentage of our guys make money. And we want one thing in return. We want access to all the data. So we can see in real time, under one login, through the back end of your brokerage account, back end of your brokerage platform, everything that every single institute trader is doing in real time. So we can monitor the risk. And they like it. If you want to see our IB contracts, go to the accounts section of the website, itpm.com. So we've got a new website up. We're on an overlap situation at the moment. So institutrade.com is the old website. ITPM.com is the new one. We've got the four contracts that we have globally available on the site. You can literally download them in a PDF. Took several years to negotiate them all. The one we have in the States, we've gone a step further now, and we're about to get another one in the rest of the world that does the same. Instead of them writing 0 on the contract, which has taken us 3-4 years to negotiate, prove the infrastructure works, let brokers like us, let brokers see that it works, give them a business hedge, show them that the business is good, and they're just being stupid if they think it's not. The one we've got in the US at the moment with TradeStation, 20% of the money that you pay, well, institute traders pay to TradeStation, gets rebated back into their account every month. So just give it back to them, up to the value of the education that you buy through the institute. So what does that mean? That means you get your education for free. You've just got to commit by putting the money up first to pay for it. Then when you become an institute trader, over a 2-3 year period, you're going to get the money back into your account that pays for the education. So it ends up being free. And we've negotiated the contract outside with a new broker that we're bringing in the next 1 to 2 months. And they're going to rebate 20% in the rest of the world. So what that is called is a soft dollar agreement, called softing. You're providing a service and the broker's paying for it. You're providing a service to their clients and they're paying for it. So we always eliminate the conflict of interest. It's one of the most important principles that we get right in the Institute, that we always implement. So unlike the other educators, we're not incentivized by volume and frequency. We're totally the opposite. We actually want you to make money. Because if you do, it means all of our data is good. So what are they, these guys? The trading educators that have got volume and size incentive. They're essentially the brokers in disguise. They're incentivized by the 4 revenue streams. Well, the three as well. 3 because they get the financing, so not the OTC gain. But the broker is paying them who gets the OTC gain, so they're incentivized indirectly. They just want you to trade as frequently as possible in the biggest size possible, so they're always going to show you trading strategies that pay them, not you. Charlatans, they're known as. Guys who pretend to be traders, but they're not. They're fake traders. They're internet marketing imposters. Here's the red flags of a charlatan educator who pushes the inversion narrative and is essentially working for the broker. Day trading always works. Well, we know it doesn't always work because the trader is a slave to volatility, and the trader doesn't tell the market what's possible, the market tells the trader what's possible. Remember our euro-dollar example, 106? Buy and sell for the next 250 trading days. Buy at 106, sell at 106. If there's no volatility, you can't make money. Impossible. So day trading doesn't always work. In fact, it works in the minority of cases. It only works in history in the last 15 years, 20% of times, on average. And that is a statistical analysis. You can't argue with it. We're looking at US equities in particular, specifically, and the major Forex pairs. And 80% of the time, it hasn't worked. The odds are not in your favor. So what does that mean? You're being told the inversion narrative. You're being told the opposite of what's true. But what does that do for the broker and the educator? Guaranteed volume every day. If you absolutely believe that day trading always works, or works in the vast majority of times, in history and going forward, what are you going to do? Well, you're a guaranteed idiot. You're guaranteed to trade all the time. Fantastic, perfect client. They get paid, not you. Next one. It's better to not have overnight risk. and to exit your positions at the end of the day always. Why is that good for the broker and the educator? Because you're guaranteed to trade twice a day. You enter a position and exit. It also just means that the educator has no idea about risk, because risk can be hedged out overnight. Risk can be hedged out for months with assets that are correlated. Next myth, you can make a monthly income from trading. Well, we know that can't be true. Why? Because you need volatility. What's one of the big educator slogans? Make $10,000 a month trading the international Forex markets. Get the life you deserve. Well, what if the Forex markets don't move? You're not making $10,000 a month trading the international Forex markets. You're losing, and they're actually right. You are getting the life you deserve because you're an idiot. But what does it mean if you believe that narrative? It means you're a guaranteed fool. It means you're going to chase the monthly income. You're going to trade all the time, chasing the income. And what happens if loads of guys chase the income? Well, you get an income. It's the inversion narrative. Trading is easy. You just need to follow a few lines on a chart. Technical analysis. Here's some signals. Follow the lines. Buy here, sell here, buy here, sell here. What does that do? Guaranteed trades. It's the mice hitting the pedal, trying to get a piece of cheese. Psychology is the most important thing in trading. If that's your only narrative, you've got nothing. If you've got a strong mind, you'll be good at risk management and make money. If that's your only narrative, you've got nothing. You don't have a trading strategy. All you need is risk management to be a good trader. Nonsense. You need ideas. If you've got amazing ideas, you can be a terrible risk manager and still make money. Next narrative, lifestyle messages. Get the life you've always deserved. One day you'll own a car like me. What are they trying to do there? They're trying to just distract you away from the reality of the industry and the realities of trading with hopes and dreams. And they're not living that life. It's a fake life because they're not even real traders. They're fake traders. And if you remember right from the beginning, we looked at boomers and Gen Xers and the problem with pensions, everyone knowing that they can't retire. This is the crux of the problem. When desperation from the middle class fools meets conflict of interest. So just two sides of the equation. When desperation meets conflict of interest, only bad things can happen. It's all designed to distract your attention away from what's important. And they're going to go to extreme lengths to convince you otherwise. The inversion narrative is huge outside the United States, much more so outside the US. But what about inside the US? We've already mentioned this in the example with you about how the commission is not paid as a percentage, it's a flat rate, but they're still the broker's bitch. They're only going to push the inversion narrative because they need a brokerage platform to put people on, to legitimize themselves. Because if they have the branding of brokerage platforms behind them, and they're working with them, and their introductions have a place to go to, it legitimizes their bullshit. They need a home. They always need a home. And obviously you've seen we turn the tables on the broker, and we've got 370 guys globally. When you've got a lot of guys who do quite well, and you provide a coupon business, the broker likes you. And you also get significant community leverage. Because if you have 100 guys on a platform and they do well, and it's a coupon business and you've provided a business hedge to the broker, do they want to lose them?
No.
Of course not. So what happens at the Institute when we want something from the broker? They become our bitch because they don't want to lose 100 clients. We've turned the tables. So what does it look like in practice, the inversion narrative? 1, IB agreement. I don't think we have to beat that drum again. But one thing you should absolutely do if you go to get taught by someone in the financial markets who professes they're an educator and they're good at teaching and they're a guru trader, ask for their IB agreement. If they're introducing you onto a platform, the contract has to be in place. It's illegal for the broker to not have the contract in place. So if the educator won't give it to you, where do you go? Well, first of all, what's the message if he won't give it to you? What's the message from the educator if they say, no, I'm not giving you a copy of my contract? They've got something to hide. Or they don't have a contract, which means it's illegal. So either way, it's bad. Where do you get it from? Well, actually, contact the broker and ask for the email address to their compliance desk. Under regulation, they absolutely have to provide it to you. They have to have full disclosure of the relationship with the educator. So contact compliance and go behind the educator's back. That's how you find out if they're incentivized by volume and frequency. Regulatory history is a big one. There is actually a real definition of what a professional trader is. So if someone claims that they are or have been a professional trader, you can find out with a few clicks of a mouse. Why? Because if they've been a professional trader, the definition is they've performed a controlled function. And the controlled function in all geographies is trading other people's money, investors' money. So investors will be at a hedge fund, pension fund, but also investment banks. The investors are the shareholders in the bank, and the guys at the bank trade the shareholders' money. They control the balance sheet. So they are a custodian of third-party capital, and they have to be regulated. What do you have to do to get regulated? You've got to take your exams. And there's a public record everywhere, in every geography. There's mine. FCA register. So Goldman Sachs, Lehman Brothers, JP Morgan, regulated to perform controlled function of trading other people's money. And Woolwood Consultants, which is a small firm that we had, 4 guys, and we had to be regulated because we traded each other's money. Very straightforward. Another easy way of finding out is if you know someone who's got a Bloomberg subscription. If you know someone who's got a Bloomberg subscription, just ask them to type your name into the search field or the name of the educator, and then click on, I think it's 8, career. And it comes up with the full career of the person who was a subscriber to Bloomberg. Now, it's difficult for retail because it costs $25,000 a year, but Bloomberg records the career of professional traders and professionals in the market. Not hard to find if you do a bit of digging. That's online. Kreil joins JP Morgan, equities trading team. That's online as well. So at Lehman before. You can literally do a little bit of digging around and find out if someone has actually been a professional trader in their career. It's not difficult. But people just don't understand what the definition is between a professional trader and a retail trader. This is Raj, one of our mentors in the US. Regulator in the US is FINRA. So Raj was the head of options trading at Bank of America, head of options trading at Nomura, worked at a few places before, but he was the youngest managing director at Bank of America at the age of 29 and ran options at 29 years old. So, bit of a player, knows what he's talking about. Takes 5 minutes to find that online. 5 minutes. Here's the rest of our mentors. So Tristan, Chris Cathy's over there. Jason McDonald. Sorry, I had to put your middle name in.
Me too.
Ben Berg-Green, who's over there. Hisham, who's arriving tonight. He should have just landed, actually. He lands at 8:30. We're doing a conference at the weekend. Hisham, you can't get it online because NASDAQ Dubai, they don't record publicly online, but we have the certificates because we only hire guys who have actually been professional traders. So you can go to any of those links and you'll find everyone's background. Now, none of our guys have to be regulated now. Why? Because we don't perform controlled functions. But the point I'm making here is this, is if you are being told by somebody who professes to be a professional trader or has been a professional trader, all you have to do is check. And what happens if you draw a blank or you can't find it? What happens if you ask them to prove it and they can't? What's happened? You've been told by a retail trader that they are a professional trader or they have been a professional trader. So what does that mean? You're being potentially taught by somebody who is exactly the same as you. Just because you have access to a brokerage platform or a trading account with a couple of $1,000s in it and you trade every day, it doesn't mean you're a professional trader or have been a professional trader. It's like me going out into my back garden every day and kicking a football and saying I'm a professional footballer. Barcelona are not signing me up next week. And I should not be teaching football. It's pretty straightforward. So anyone can do their research. And if you don't, you're actually being really irresponsible. All you have to do is check the regulatory history. So check for the IB agreement, check for the regulatory history. The vast majority of trading educators in the market have absolutely zero professional trading experience. They are retail traders pretending to be professional traders. And it takes one check. So now you know the definition. If they have no status, no history, having a controlled function of managing other people's money, it means they've never been a professional trader, and they can't claim to have been one. It's a binary outcome. You can't get a little bit pregnant. You're either a retail trader or a professional trader. You're either pregnant or you're not. They're just pretending. So they'll have the IB agreement. They'll pretend that they're professional traders. How do they pretend that they're professional traders? Well, we live in an online world, and they'll create completely manufactured backstories of their lives. The most common one, and I like this word, it's a German word, Wunderkinder. The wonder kid. The kid that came from nowhere. And usually the lie is they turned an amount of money, like $10,000, into a big number, like over $1 million. The wonder kid turned $10,000 into $1 million. Now, why is that convenient? Because everyone can afford $10,000 to open a trading account. Most people in the Western world can just put it on their credit card. So it's the perfect bullshit story to get people to pay for education and put 10 grand in their trading account. And it's simple for people to understand. Oh, you turned 10 grand into $1 million. Fantastic. I want to do that too. Follow a few lines on a chart. The other most common one is if older guys, they'll say that they worked at hedge funds or investment banks, or that they work at a hedge fund now, or they run their own hedge fund. It's complete nonsense. If they did work at a bank, it's probably in a support function, and they'll have no controlled function. So they'll be working in IT or operations, or even working on the trading desk and getting the traders coffee. If they haven't been regulated to perform the function, they've been at the bank and not performed a controlled function. So it means they were in support. The hedge fund one is very disingenuous because retail traders have been picking up newspapers and watching TV for the last decade, reading all about these whiz guys in the market called hedge fund managers. And apparently, according to charlatan trading educators, all you have to do to be a hedge fund manager is open a retail brokerage account and put $5,000 in it. That's all you have to do. And you can call yourself a hedge fund manager. Wrong. A hedge fund is a very, very specific investment vehicle with very specific parameters and moving parts, very specific infrastructure. And you need 5 things to be defined as a hedge fund. You need an offshore registered fund. 80% of them are registered in Cayman Islands. You need an onshore management company, so that's usually in New York, London, Geneva, Singapore, Hong Kong, Sydney. The offshore fund, you have 2 charges. You have the management fee, so the offshore fund is charged by the management company a fee to run the assets per year. And then you have a performance fee. So it's usually 1 or 2% management fee, 20% performance. You have a third-party administrator. So what they're doing every day is making sure that the management company is implementing the agreed mandate from the offshore fund for the strategy that investors have invested in. You need a prime brokerage agreement with a top 10 investment bank. No investment bank will look at you unless you've got $30 million commitment up front. Total waste of their time. Investment banks want clients. They want big clients who are going to trade. And you need a seriously strong track record. Minimum 3 years, probably 5 years. Obvious question, why don't we set up a hedge fund? Well, it's the wrong way round. We are not the hedge fund taking investors' money to make investors rich. We are the investor. So the front door of the institute, there's education, but we're also trading our own money, and we have 40 trading accounts within the institute. And if we find good people, we seed them on power of attorney with real money, and they get to trade our money. Now, it's not a requirement. You can just exist in the infrastructure and be good and join the community and help everybody out. That's fine. But that's the way we look at things. We want to invest in traders. We don't want to take outside money. And if you look at these guys, the weathered faces of the mentors over here and mine, we've all been in the industry for years. We've done our time. When you wake up at 5 o'clock in the morning for 10, 15, 20 years to make other people money and to make shareholders and investors richer, and you make a lot of money yourself on the way, when you've made a certain amount of money, you don't need to get up anymore. You can make a lot of money by doing not a great deal. So all our guys are retired, and we just trade our own money. And as you've seen, hedge funds are a very specific investment vehicle. How much does it cost to set up a hedge fund structure? Over $1 million. If you don't need it, you don't do it. It's stupid. It's vanity over sanity. So we saw manufactured backstories. IB agreement, regulatory history, manufactured backstories. What about manufactured trades and deception? You'll see this a lot in the online world. You'll see lots of educators active on social media, posting screenshots of charts. And this is essentially hindsight trading. So for example, posting a picture of a chart on social media with an arrow that points here and an arrow that points there, saying, I bought it here, I sold it here. Congratulations. Well, anyone can do that. Anyone can pull up a chart and say, I should have bought it at 5 and I should have sold it at 8. It's just bullshit. So that's hindsight trading. What about predicted trading? Predicted trading is very disingenuous because people who don't understand the industry can fall for it very easily. So what about posting a chart before an event with support and resistance and saying, prepare for the big move. And then afterwards, you actually get a screenshot of a real trading account with showing a profit of, say, $3,248 with a narrative next to it that says, just made $3,248, it's only 10 a.m., that's me done for the day. I'm off to the beach. This quite literally is the oldest trick in the book, and it's been going on since the 1920s. They've got two trading accounts. They go long in one and short in the other, and they post a screenshot of the one that makes money. And it's the oldest trick in the book because it actually comes from brokers. Because in the old days, brokers were advisory brokers. They would advise their clients what to go long and what to go short in the market. And if you've got 100 clients and you're an advisory broker, and this is going all the way back to the 20s, do you tell all your clients, your 100 clients, if you have an idea to go long, do you tell all of them to go long? Of course not. You want to grow your business to 200 people. So you tell 50 to go long, 50 to go short, 50 of them make money, 50 of them lose money, and then the guys that lose money, you help them on the next one. And you grow your accounts from 100 to 110, 130, 200. It's the oldest trick in the book. All that's happened is it's just become modernized by the educator who is the broker in disguise. That's all it is. And this is why basically any professional trader with any respect for their career will never post their trades. Because they will lose all of their gravitas, all of their respect in the professional trading community, because every professional trader knows that they're probably bullshitting, because they know all the dirty tricks. So there's a side of the industry that's totally opposite to everything that you experience as a retail trader. But it also breeds a dependency culture as well, which is exactly the opposite of the way traders are taught in the real world, like professional traders. So people signing up, for example, to hot stock lists. Here's the top 5 stocks today. Here's the stocks in play. Here's the potential news. Get long, get short, get long, get short. What's happening there? That's the educator pushing the inversion narrative because they're working for the broker indirectly. And what are you doing? You're depending on those lists or those ideas every day to try and generate a P&L for yourself, try and generate a profit for yourself. It's the total opposite of the way you need to be taught. You need to be coming up with your own ideas and generating your own ideas. Manufactured trades and deception, again. Deception, this is how the online world works with people who have a false narrative. They know everything they say is bullshit, but they have to give the impression that other people believe it, so you get sucked in. So there's 2 things you need to watch out for: sock puppets and meat puppets. What's a sock puppet? Well, put a sock on your hand and speak. You open 400 social media accounts, different email addresses, different names. What do? You pretend to be people commenting on all of your posts, and you're logging in to 80 of them per day and making the comments. There's a huge amount online of complete nonsense, and people get sucked in by it. What's a meat puppet? A meat puppet is a sock puppet, but it's a human. They're hiring someone in Bangladesh, China, India, wherever, Russia, to log into the accounts and do it for them. And they'll upvote all their comments to get them to the top. So it looks like there's a narrative occurring that believes they're bullshit. So then people get sucked in. They build fake websites, so they'll comment on other business people and then comment on themselves. That's a sock puppet fake website. Fake reviews, and they'll give reviews on themselves, obviously that are favorable, and then reviews on their competitors that are not favorable. So this is how they all do it. Or they can literally engage in actual criminal activity, which is creating equity curves of trades that they claim they've done going back in time, which shows them making money over time. And all they've done is gone into a spreadsheet or the back end of a website and typed in buy at $5, sell at $5.65, and it just updates their equity curve. And it's not audited by third parties. It's not audited by accountancy companies. They don't have administrators. It's self-administered, and it's actually criminal activity. Because what you're actually doing is you're mis-selling financial performance. Lifestyle and social media posts. This is the stuff that's designed to distract you. So drastically overemphasizing the conflation between trading and lifestyle. So of course, if you know what you're doing, it doesn't matter where you press the button. It's less than 1% of what you'll do as a trader. It's the other 99% that's important. You can't be sitting by a pool coming up with 10 really good trading ideas per week. You actually do need to work. You can press the button when you're lying by the swimming pool, but you have to do the other 99% of the work. And you can always tell an educator that's had no trading experience because they'll constantly push the lifestyle narrative. It's creating the hopes and dreams. And how do they do it? Most typical ways, renting houses on Airbnb and doing MTV crib-style tours of their houses. But they'll literally rent the house for a day, and they don't own it. It's rented for a day. Or they'll rent a supercar for a day. And in the house and in the car, they'll film all day and collect 3 months of content and drip it out over 3 months. So they build archives of content to drip out the inversion narrative. Possibly my favorite is withdrawing cash and parading it, saying that you made it in trading. That's where you get it from. Prop movie money store. There's $1 million on sale for $450 in new style, aged look 100s. That's where they get it from. And of course, when you wrap all of this up together, the IB agreement, the no regulatory history, but telling you they're a professional trader when they're actually a retail trader, the manufactured backstory, the manufactured trades and deception practices that they engage in, and the lifestyle and social media posts. Of course, the cherry on the top of the cake is the reason why they do it is because they want to inspire you. So you can one day be like them. So you open a trading account. 20 days later, you're gone. Congratulations. But there's other areas of trading infrastructure where IB agreements are very important. Trust me when I say this. IB agreements are everywhere in trading. They're not just with educators. They are everywhere. They just work in slightly different ways. So they're in managed programs, automated or algorithmic managed programs, social trading, and with online forums and information vendors. Let's start with managed programs. So there's a difference between a sophisticated investor and a retail investor. Retail investors are usually under $500,000 qualified. Sophisticated investors are over $500,000 qualified, usually with industry experience. So there's a gap in the market between retail traders and funds, where sophisticated investors invest in hedge funds, because hedge funds will only take a minimum of $1 million, $2 million. And you first have to be qualified as a sophisticated investor. Retail traders can't invest in them. So what do retail traders invest in? Oh, this infrastructure that is supposed to look like hedge funds called managed programs. So you have these guys who are managing retail accounts where you give them money to trade. They've all got IB agreements with the brokers, every single one of them. So there's a conflict of interest, and what tends to happen? 90% lose money. Why? Because when their managed account goes up in value, they churn like crazy. They trade, they trade, they trade, they trade. And then the commission goes in their back pocket from the brokerage company as a rebate. And when they're down, they just churn less. So it's a churning mechanism. What about if we automate that? So we take away the human and we say, all you have to do is put money in this trading account, and every time this particular account trades, you do exactly the same trade. So it's automated. So there's no human managing it. The human is managing their own money, and you're just copying their trades. What about if we automate that? Now, the way that's set up is you have what's called a master account at the brokerage company, and then you have hundreds of retail traders who want to outsource their trading to somebody who's supposed to be good. What's happening there? Well, the guy with the master account has an IB agreement with the brokerage company. So every time the master account trades, or that guy trades, you automatically trade. It's the same thing. It's just two separate accounts instead of one. So what's happened there? Well, the broker has just outsourced pickpocketing to a machine. What about social trading? You've seen them, all these platforms where you go online and you see all these guys in weird places around the world with nicknames. Forex Master 179 was up 100% last week, based in Kazakhstan. The new master trader we're promoting on the platform. What's he done? He's turned $100 into $200. And you're about to give them 5, 10, 15, 25, 100 grand. They're never going to be able to manage that money. They've got lucky. Because they never advertise how much money they're actually managing, or very rarely. But something that's very, very, very rarely advertised, and no one really knows the real truth about it, unless you're inside the industry. 80% of their profiles are fake. The people don't even exist. They've created fake profiles, and the social trading platform is the brokerage platform. They own it. Or, if they don't own it, they have an IB agreement with the brokerage platform. So what are you doing? Well, you're just doing the previous example. The broker has set up an algorithm that fires off signals through certain accounts, and you've set up a sub-account under a master account. That's all you've done. And then you're automatically copying the trades of that person that doesn't exist. And all these guys get away with it because they're regulated in places like Cyprus and Malta, which are in the EU, but they can actually passport their regulation into London. So they end up with FCA regulation when they really shouldn't. And the regulators have actually started coming down really hard on them in the last few years. And there's been multiple investigations into the social trading platform sites. And they've actually found that 80% of them are fake profiles. So all the owners of these platforms for the last 2 years have actually been looking for an exit at favorable prices. And yours truly was offered one of them for £10 million. So we decided to send in a couple of people to do some due diligence, and confirmed 2 weeks later, 80% of the profiles are fake. Well done. You've just been duped again. IB contracts or brokers. Online forums. Do you think online forums were built for your benefit? So you can go on and chat to some guys who you don't even know about stocks, Forex, commodities? They're not built for your benefit. A lot of the profiles are, again, fake. And the forum owners, the companies that own them, are actually incentivized by IB agreements. Try clicking on the broker ads on the right-hand side of the screen. See what happens. New window opens, URL. Check the URL, what it says. It's an affiliate program. And they have an IB agreement with the broker that's advertising on their platform. We've downloaded many of the company's accounts to forensically go through them to see where they make their money and how they make their money. Because we see the URL links as affiliate links, and we know they're getting paid by the broker in commission. So you go on to company's house, download the last year's accounts, the accounts before. How do they make their money? Mostly through marketing and advertising. And what is marketing and advertising revenue? It's brokers paying rebates on IB agreements. You need to understand how the industry works. So what's going to happen when you go on an online forum? Well, the online forums are in direct competition with trading educators. So what's their narrative? All education is crap. Well, of course, most of it is, because most trading educators have IB agreements where they get a percentage rebate. But there are real players in the vast minority, and we're one of them. But what are they going to push on their platform? They're going to diss all educators, and they're going to diss brokers that are not advertising with them. And they're going to push you with the inversion narrative, and they're going to promote forums that promote the inversion narrative and send you and push you towards the brokers. They'll even set up fake profiles themselves, and they'll call themselves, for example, veterans, as having been on the forum for 10 years and added lots of content to the forum that other accounts that are fake respect. So they're basically sock puppets. And they'll push you towards the brokers. So you think you're talking to a guy that's got a reputation that's good. It's a guy working at the forum. You need to be very, very suspicious of how all these guys work. There's huge conflicts of interest everywhere. So consider what you've been shown today. Just think about everything, how everything works. How the parameters of the industry are literally set up for retail to fail. The infrastructure was built for retail to fail, not for them to benefit. How hedge funds, pension funds, and investment banks are the largest payers of exchange fees. And exchanges need them to survive, to maintain the status quo. How investment banks in particular absolutely require dumb money to exist. And they enable the infrastructure by providing the credit, the financing to retail brokers. How investment banks need their largest commission payers, hedge funds and pension funds, to survive, so they continuously get paid. How retail brokers and their IB incentivized educators are literally contracted and incentivized by the infrastructure for retail to fail, so everyone gets paid. How retail brokers and charlatan educators constantly push the inversion narrative. How, as a retail trader with a small account, you don't really have a choice. You have to trade on the platforms. That's how you get access. And how regulators will never actually prevent a problem. They will only ever react to casualties of past problems in the markets. And then now we've stated all this and we've got to this point. I want you to ask yourself a very, very important question. Is it even possible for retail traders to make money? You've got to access the platforms. So let's have a show of hands. Who believes retail traders can't make money? One, okay. Who believes retail traders can make money? Okay, you're right. But like right at the beginning, when we said the most important thing is to look at how the industry works. What did I say at the beginning? Look at how the people who do well in the industry work. And if you're a retail trader, you can make money if you find those people and emulate them. It's pretty straightforward. It's like walking into any industry. Find the players who win and do what they do. Form 10K. It's an annual report in the States for a public company. It gives you all the forensics of the company. Who should we look at in the trading industry who's extremely successful to see what their odds are of making money? Yes, why don't we look at Goldman Sachs? That's where all the most successful traders in the world seem to come from. So let's find out how they make their money. Go online, type in Goldman Sachs 10K, and type in the year. You'll find it in the first two links. It's out every year. It's an annual report. between pages 95 and 105, you will always find this chart. And it tells you the amount of money that Goldman Sachs makes or loses per day, how many days they make and lose. So what have we got here? Intervals of $25 million, okay? On the right-hand side are days where they make money. The left-hand side, days when they lose money, and how much they make and how much they lose. So in the year 2015, Goldman Sachs made money on 212 days in the trading year and lost 38 days. And this is trading operations, pure trading, nothing to do with M&A, commissions, or anything like this. So pretty skewed to the right-hand side. And you can see that on a typical day when they make money, they make between $25 to $50 million. So there's also a tail out there as well. Look at the tail on the right-hand side, where there's up to $100 million. With 34 days out of the trading year, they're making $100 million. Amazing, right? Why do you think they're making $100 million? Because they call the markets correct. The big situations when markets move, they get it right. And then when the markets don't move, they trade in different ways and they just make money every day. Do they go home with flat positions every day? No. They're running multi-billion-dollar portfolios. They just let the portfolio work and they let the money come in. And they don't stand in the way of it. Huge overnight risk. You can speak to Chris Caffey about it later at the pub. We used to run crazy numbers. A couple of $1 billion on the pan-European trading desk. We'd have between 200 and 400 million of that risk. And we'd run portfolios. And that was even back in the early 2000s. We weren't day trading. Just big portfolios that make money. So 2015, was that a fluke? Was that a one-off? You can actually go back all the way to 99. But let's go back a few years, see what happens. 2014. Thank you very much. What about 2013? What about 2012? That was a decent year. What about 2011? You can go all the way back to the late 90s, since they became a public company and started putting out these numbers publicly. It's the same every single year. Why? What percentage of retail traders lose money? What are they doing? Everything on the right-hand side of the chart we looked at earlier. What percentage of days do Goldman Sachs make money? 90. What are they doing? Everything on the left-hand side of the chart that we looked at earlier. It's not that difficult to work out if you know what you're looking for. So, shouldn't we be doing exactly what these guys do in our own trading accounts? And become the most annoying clients of retail brokers in the world? Guys who make money. Everything that you've got to do in your retail trading account needs to be the same way that these guys do it, on the left-hand side. So you have access to the platforms, it's necessary to use them, but you do everything in the opposite way to the way they want you to do things. And you learn how to do it properly. And there's no shortcuts. You've just got to do it. So right back to the beginning, be warned. Our campaign, continuously for the last 5 years, is to first educate you on how the industry works. So you don't make the stupid mistakes that everyone else makes. That's what you got today. The next stage is to educate you on how to actually make money. So how you actually emulate professional traders who are real professional traders who have got the experience, been there, done it, and have made a lot of money and continue to make money. You've just got to go straight to the source. So you've got to be woke. And I hope this has woken you up. Because the reality is if you don't go down this path, you will go down the other path. And you will blow up. And we don't mind. We'll be around next year, the year after, year later. You'll just come back. But it'll cost you a lot of money to learn the lesson, if you haven't learned it already. I guarantee you there's people in this room that have learned it already. Most retail traders in the US lose $20,000, $30,000 before they decide trading is not for them. But they never get woke. They never find out the real reason. And the real reason is the stuff you've seen today. You've got to go straight to the source. So just don't waste years of your life. It's no skin off our nose if you do. We'll still be here. So here's our general website. We've got a new website, ITPM.com. You can sign up for free seminars around the world, /seminars. If you want to go straight to the online education, go to itpm.com/education. We've got 2 programs. All the information's there online. We've got mentoring programs direct with our trading mentors, and all the guys are hired on very strict requirements. They have to have been professional traders for years and made significant money. And they have to prove it. Trading accounts, IB agreements, itpm.com, trading accounts. And if you've got any further questions, go to the FAQ section. Check all those questions. If you have any further questions, after you've seen the FAQs and the answers, send us a message through the website, through contact form. And we have 2 acronyms at the Institute, which I'll leave you with. GTFOH and DFIU. Get the fuck out of here and don't fuck it up. I'll see you at the pub.